Good afternoon, class. Well, it's hard to believe, but it is our last day of classes today. 15 weeks. So for today, we are going to do a review. We're not going to do any problems, any math problems like that, any Excel work. But if you do have questions on that kind of stuff, I would definitely suggest, going back to the homeworks and the quizzes that we have and practicing those problems. So I'm going to spend more time focusing on some of the terminology and the concepts that we talked about, and then I will list the calculations that you'll be expected to be able to do, but I'm not going to go through those calculations. And hey, for a lot of you, this is going to be the last finance class you have to take. Yay! But I will say this: in your last semester, usually you take the capstone class, and the capstone class will have some finance in it. You do this thing called a CapSim simulator, and the capstone class uses that to so you can see how marketing and finance and accounting operations, all these different parts of business work together when it comes to actually running a company. So you guys will get to do that, and some of the finance stuff in there will come up. I know they usually try to have a finance concentration or major student on each team to help with those decisions. But I just wanted to give you guys a heads up on some of that stuff because one of the things you have to do in that is not something we cover in Finance 300. We actually cover it in the next finance class, which finance majors take, and that's on how to determine how much debt a company should have. What's the optimal levels of debt? You can run a company and just use equity money, common stock or your own equity money, and have zero debt. That's fine. But the whole purpose why some companies like to take on debt is there are some tax advantages to it, and you can increase the returns for for equity holders by taking on debt to make more investments. So I just wanted to give you a heads up on that. And so if you're in that capstone class and you have to decide how much debt for your company to have, the best thing is to take on the industry average. Okay, that's typically what companies do. We have some theoretical models, and usually they resolve around how risky the company is. So the riskier the company is, the riskier future profits are, less debt you should have, because you don't know if you're going to have enough money to pay your loans. And so just keep that in mind. There'll be also some financial ratio calculations that you'll have to do in that class. You'll probably forget some of that stuff by the time you get there, but hopefully you can look that stuff up. And some of those financial ratios that we covered, and they're pretty basic. Once you look up a definition, you just kind of Google it and Investopedia or something like that, and you see what the ratios are. So that's not too big of a deal. But for when they ask you about how much debt to take on in a company, usually it's industry average. You don't want to take on too much. Taking on too little or none is fine, but then the only thing is that you won't be able to invest in as much opportunities like new product lines, and you probably won't win the game, so to speak, if that's your goal. Do you guys have any kind of other questions about finance in general? What's going on in the financial markets? Anything that's we didn't get to cover over the semester? So the final quiz is going to be on chapter 12, and then some review questions on chapters 1 through 11. Chapter 12 is going to be, I think I said, somewhere between 3 and 4 questions. and then chapters 1 through 11 will be somewhere around 11 questions, something like that. So I'm kind of aiming somewhere between 14 and 16 questions. All right, so the class was basically split up where the first, three or 4 weeks, right? We kind of did an overview of finance in terms of this is what companies look like, and this is how finance looks in the company in terms of its role. We looked at how corporations are set up and some of the issues with corporations and how taxes are different and shareholders are different in different types of companies. We looked at financial markets and institutions where investors and companies kind of come together to exchange money, usually where one person wants to make an investment and another person needs money to build a company. And then we also did some financial analysis where we looked at how to look at spreadsheets from a financial perspective and determine how kind of questions to ask and how a company's doing, and financial ratios. So that was kind of the first part of the class, and then we moved into time value of money. Time value of money, I think that was chapter 5, right? And time value of money was really the beginning of how we do our math calculations for our investments in finance. So those parts kind of were chapters 1 through 5. So I'll go through the bullet points in a little more detail now, but that was kind of really the first part of our class. So for the type of firms, the key here was we had sole proprietorships on one end where you start up a company. Maybe you just have to get some business licenses, but there's not a lot of legal entity requirements because the person who starts the business is the business, and they pay taxes based on their own personal tax statement, and they assume all the liability. On the other end, you have kind of like a C corporation where they can have as many investors as they want. They can sell shares, but there's double taxation in that the corporate entity has to pay taxes on the profits, but then shareholders may also have to pay taxes on the dividends that they get. And so it varies from country to country. Some countries do not tax dividends, but some countries do tax dividends. And then in between the C Corp and the sole proprietorship is something like an LLC. And those are one of the most popular forms now because you don't have that double taxation. The profits are split up between the owners of the LLC. And if they decide to, they might split up the profits in a different way that they split up the losses, depending on who can take tax deductions. But the nice thing is it's kind of a hybrid between the proprietorship or partnership and a C Corp because you can, you have some a veil that kind of protects you from liability, but then you don't have the double taxation. So that's a pretty popular form for most people who are starting businesses these days. In fact, if you wanted to know more about the different types of legal structures for companies, check out a website called LegalZoom. It's a pretty easy kind of self-help kind of legal documents provider, and it's not a bad. Some student had asked me about it, and I suggested he go there. In fact, maybe he's on the website here on our lecture, but hopefully that helped. The alternative is to obviously go to a law firm, and that can get pretty expensive. I know because my brother-in-law did that with with companies in Silicon Valley, getting them ready for IPOs, and they do a lot with the legal paperwork and how they can write up who the ownership is, and that's an important thing for planning when they do their rounds of funding and making sure all the ownership shares and who gets what % of the company is all legal detailed and everything. So the different types of firms, and it affects finance because one, you may have shareholders or not have shareholders, and two, the tax structures are different. And that took us to the goal of the firm. And from a purely economic standpoint, the goal of the firm was to maximize long-term value for shareholders. But that has really changed quite a bit over the last 20 years. There's much more emphasis on what we call ESG, environmental, social, and governmental aspects. So I think there's much more pressure on companies to take those things into account. And a lot of this because they know that if they don't, that it could affect the long-term value of the company because customers will leave that company if they feel that the company is not doing a good job of those things. And so that's really changed quite a bit. And the other thing is you will notice differences in how firms are run and the goals of those firms from different areas around the world. Like in Europe, you see more where governments have a little bit more of a direct say in some of the really big companies, and especially labor unions as well, because they'll actually have a certain number of board seats on the board of directors where they can vote on things that the company does. You don't typically see that in U.S. companies, but European companies, you'll see that more. So that's just something to keep in mind that, when you analyze investment projects, it's not always about finding the project with the biggest NPV. Sometimes you do have to do projects that don't have positive NPV from your analysis. But, when you think about what a firm has to do to be kind of a good citizen in their community, they have to maintain that. So there's projects you do that don't have positive NPV because of that. Now, one of the aspects that we talked about with like C corps, where you have lots of shareholders, a diverse base where nobody knows who the other shareholders are, is that then they have to hire a kind of an outsider to run the company. And so that outsider, or could have been an insider, but that person who's hired to run the company is kind of like an agent for the shareholders. And so that's where we get something called agency problems, because once you have someone who you're hiring to run your business, there's the potential that they may do things that help them as an individual, but not the shareholders. And so we call these agency problems. And that's why companies take actions to limit agency problems, because it could hurt shareholders. So you see things like stock option compensation for CEOs. And the idea being that if a CEO is also a shareholder, then they'll want to do things that are in best interest of shareholders. So giving stock options is a way to do that, because then they only make money when the value of the stock goes up. And then we got into financial markets and institutions, the fourth bullet point here. And that's where we have people with money. They're looking to invest or save or borrow money. And then we also have companies over here, and companies need capital to invest to grow and build their businesses. So how do we get that money transferring from those two sides? And that's where financial markets and institutions come into play. Financial institutions are the middleman, if you will, when you have transactions, especially those transactions that cannot be automated. Financial institutions come in there and they do all the legwork between, okay, this investor wants to buy this IPO and this company wants to sell shares, and they kind of bring these people together. When certain financial transactions are done so often, they get thoroughly automated, we start having financial markets. And that's where we have high volume transactions happening. And a lot of that stuff, like I said, it can be fairly automated. And also financial institutions sometimes go on those financial markets themselves to transact for their customers. So that's kind of like, that was all about the flow of money, the flow of capital. And the idea being that in the best functioning market, the money flows to where it's needed most and it does the most good. And if you have a well-functioning market, that's hopefully what happens. And then we talked a little bit about book value and market value for a company. And the key there that was, while we do use book value sometimes, we have to keep in mind that market value is where the actual, that's where we can see the true impact of a company in terms of what investors think about it today. Because book value is a little more backward looking and it's historically based. And from a financial standpoint, if we're doing analysis about the future, we really need to use market values. We looked at something called free cash flow. And back in like the early chapters, we just looked at the equation and just said, this is the number we use instead of net income, basically. And when we do financial calculations, we use free cash flows, and we looked at some of the issues with using net income that work well for financial statements and giving investors information about the economic profitability of a company. But for making investments going forward in the future, we needed to know a little bit more different information. That's where free cash flows come into play. And taxes are a big part of cash flows. We looked at taxes and we looked at how to calculate taxes, especially taxes where there's a graduated tax rate. Like by graduated tax rate, I mean like you have one tax rate for a certain amount of income, like let's say 0 up to 100,000. And then for 100,001 to 150,000, there's another tax rate. And so that's typically how tax rates are. They're usually graduated, so they go higher and higher as the income goes higher and higher. And then we got into financial analysis, and starting off with horizontal analysis. And horizontal analysis is when you look at financial statements over time. So like if we had an income statement, right? And the income statement goes down the sheet. And then over every column, as we go horizontally across, we'd have a different year. So horizontal financial analysis basically means we look at the annual performance of a company over time. And one of the things we learned when we did that was to calculate something called CAGR, C-A-G-R, that's the compound annual growth rate. And what we did is we calculated this CAGR, right, for all the different categories going down the income statement. And what that allowed us to do was to kind of see which accounts on that income statement were growing faster than others. Because this differential growth rate can be good or bad depending on which account you're talking about. For example, if profits are growing faster than sales over the last 5 years, that's a really good thing. It means a company is becoming more and more profitable and they're kind of leveraging their past investments and they're not having to invest as much in the business. But what if like cost of goods sold is growing faster than sales over the last 5 years? Well, that's a potential problem. And so horizontal financial analysis would kind of make it easy to see this, but it wouldn't answer the question why. So financial analysis helps you give you the questions to ask a company's management why certain numbers are changing the way they are. And it's and their answers to those questions are what really drive your decision about the health of the company. Vertical statement analysis, that's when you go down the income statement. And we, starting off at sales, cost of goods sold. And so at that point, what we're doing is we're looking at all the different accounts on the income statement as a percent of sales. So like what's cost of goods sold as a percent of sales? What's SG&A as a percent of sales? So when you see these accounts as a percent of sales, and then also you can look that over time as well, it helps you compare one company and one company versus another company. Like you can say, oh, wow, this one company has much better gross profit margins than this other company. What are they doing better? What's their secret to their success? So A vertical statement analysis kind of shows you how you get your net income at the very bottom, and it kind of helps you, kind of find the questions to ask when you're doing financial analysis, or look for the opportunities of how to improve, because you might look at all your competitors and do this on all their financial statements, and you might say, hey, this company is really good with their, I don't know, maybe their SG&A. Let's find out why. And so it's kind of beneficial from multiple perspectives. Then we looked at various financial ratios. I'm not going to go over all those financial ratios here, but just make sure you have some notes printed out or something. And usually it's just plug and play with the financial ratios. But also when we did them, we kind of talked about, well, is it better if this number is higher or lower? Like if we look at inventory turnover ratio, for example, is it better to have a high inventory turnover ratio or a low inventory turnover ratio? That would be something to think about. And make sure you have that, kind of written down in your notes. Okay, so then that was the end, I think, end of chapter 4. And then we started getting into time value of money. And we started off with the future value equation, the present value equation. And then we could also solve for the amount of time for a certain present value to grow into a future value, or the interest rate, discount rate, R, needed to grow a certain amount from present value to future value. You had the choice. You could either do the math on those, or you could do the ones using Excel. We looked at perpetuities. Perpetuities are when you have the cash flow the same for every period and it lasts forever. And that was actually a math formula to calculate the present value of a perpetuity. It was just the annual cash flow divided by the discount rate. That's the whole present value. I think that was the only one where you couldn't use Excel to solve. And then we looked at annuities. Annuities, the math formula was a little more cumbersome, but it was still pretty doable. And annuities are basically where you have the same cash flow for a certain period of time, 20 years, 30 years, 5 years, 10 months, whatever. But it was a certain amount of cash flow and it ended at a certain date. Sometimes annuities would be, you might have problems like loan calculations. If you have a 30-year mortgage, what's your loan payment going to be? We did problems like those. And then we looked at inflation. And we saw how, nominal numbers are the numbers that we see and use every day. But if you take out the effects of inflation, you can see the real underlying numbers, the real numbers. And that can be beneficial if you want to understand, what's the purchasing power difference? Like, what's the purchasing power on a certain level of income in 1900 versus 2000? You can do that by taking out the effects of inflation. And then we looked at something called APR. APR stands for annual percentage rate. And the reason we have annual percentage rate and you see it advertised on loans or savings accounts is because when they put financial loans together or different types of accounts, they kind of have a choice as to how often they calculate interest. And that period of which they calculate interest is called the compounding period. So like people can calculate interest on your loan daily or monthly. Some credit cards, they calculate interest continuously, which is sounds crazy. But APR, what it does, no matter how often you calculate interest, it converts it into an annual percentage rate. And so it makes it so as a consumer, it's easier to compare one loan versus another loan by comparing these APRs. Because, if I tell you, I'm going to charge you 0.5% every 2 weeks, and someone else says, I'm going to charge you 1% every month. Which one's a better deal? So if you calculate the APR on both of those, it allows you to make a more direct comparison. The EAR, that was the effective annual rate, and that takes compounding into account. It's kind of like the APR, but it takes compounding into account. So it's actually a little more of an accurate way to compare two interest rates. But for our purposes in the United States, it's APR that you see advertised. And there's some rules, laws that companies have to follow, and that's kind of why they use APR. The next point, delayed perpetuities and annuities. Let's cross that one out. I'm not going to ask you about delayed perpetuities and annuities. I think I actually took that out of the slides when we were developing that. Yeah, so that second to last bullet point there, we're not going to cover. That's not going to be on the quiz. Periods less than 1 year in present value, future value. The last bullet point. That was where we would be given an APR, and then we'd have to calculate like a monthly payment. So we'd have to convert the APR, annual percentage rate, to a periodic rate. And so we had to know how often, what the period was. And it's basically whenever the cash flows are done. So like on a monthly loan payment, you have to take an annual percentage rate and convert it to a monthly percentage rate. And you just do that by dividing by the number of months per year. And then you can go ahead and do all your future value, present value formulas. The key is that you have to have your periodic rate equal to how often the cash flows are when you do your future value and present value problems. So that was chapters 1 through 5. Any questions on some of that? I know I didn't go down to super detail, but it's kind of hard to go down to the micro detail in the last class. But I just wanted to refresh some of your memories. We covered this stuff. We had homework. We had quizzes on it, but hopefully this will be somewhat helpful. More helpful than starting new chapter 13, right? All right. After time value of money, we went into chapter 6. Chapter 6 was on bonds. And before I do that, I had a question here. What would be the best way to review the material? This will be in the chat. So I'll give you a couple ideas of how I would do it, but I also understand that different people have different ways of studying. Like some people prefer to read a book, and other people prefer to listen to someone talk about something. And so part of that kind of depends on you. At this point, since we're down to the last quiz, I don't think going through and reading the whole textbook or reading through all the PowerPoint slides, I don't think that would be the best use of your time at this point. I would focus on number one, going through and understanding how all the homework problems and quiz problems were done. And then also making kind of a list of the key concepts and terms you need to know, and have, definitions with them so you understand and have, easy access to those. I think that would be the best way. Yeah. And you could use this PowerPoint slide as kind of an outline if you want, if you don't already have one for some of the quizzes that you made with the concepts and terms. But you could use this PowerPoint slide if you wanted to do that. So chapter 6, bonds. So we basically looked at some of the terminology around bonds, how bonds work, and then how to calculate the price of bonds. That was the whole thing with chapter 6. Um, and basically bonds, right? You take the present value of all those future interest payments, and we call those interest payments coupon payments, right? And also the repayment of the par principal at the very end, because bonds are different than consumer loans. In consumer loans, you typically pay interest plus part of the principal with every single payment, right? Such that at the very end, you've got nothing left to pay back and you're all paid up and good. Bonds for corporations and governments are different. Those bonds have coupon payments, interest payments built in every period, so that the person who borrowed the money only has to make interest payments as they go. And then at the very end of the loan, they pay up, they pay the whole lump sum principal back in one payment. So that's a lot different. So when we do the present value calculations on a bond to come up with what we think the bond should be worth, it's all about coupon payments every period. And at the very end, you have the last coupon payment plus the payment of the principal back. And that coupon payment, we calculated that by getting the coupon rate. The coupon rate is kind of like the interest rate on the bond payments. And you just take that coupon rate and you multiply it by the par value of or principal or face value of the bond, and that's where you get your coupon payment. But sometimes coupon payments might be annual or they might be biannual. So you might have coupon payments twice a year, right? So don't forget that. And then we looked at something called interest rate risk. And what we found out with bonds was that once a bond is sold, the price of the bond can actually fluctuate over time, because bonds are bought and sold in the financial markets, and there's no guarantee that a bond has to stay worth $1,000, right? Because typically with bonds, the face value, which is kind of the same thing as par value, is $1,000. And that $1,000 represents the principal amount of the loan. And once a bond is sold, investors can sell them between each other, and nobody says the price has to stay $1,000. So this price fluctuates up and down, and the price can go below $1,000, it can go above $1,000. And one of the things we found out was that when interest rates change, it affects the price of all the existing bonds that have already out there, such that, like, if you bought a bond when interest rates were really high, so it has high coupon payments, high interest payments, but then interest rates go down after you bought that bond, and the new bonds have really low coupon payments. That makes your old bond more worth more, because it has higher coupon payments. So the price of that old bond you bought is actually going to go up. And so that was the key thing with interest rate risk, is that there's an inverse relationship between bond prices and current interest rates in the market. If interest rates go down, old bond prices go up. All right, then we looked at current yield. And current yield is basically, it's a yield you calculate. It's the annual coupon payment divided by the price of the bond. And so that's kind of like one way to look at how valuable the return is on a bond. But usually what we do is we look at yield to maturity. Current yield tells you kind of like what you're going to get right now if you buy a bond. And yield to maturity tells you if you buy a bond and hold on it until the very end, until it becomes mature, what your average annual return will be. Current yield, a little more short-term focused. Yield to maturity goes to the life of the bond. And then we looked at how to calculate the rate of return on a bond if you did not hold it to maturity. So, like, what if you bought a bond this week and then sold it in 6 months? And we could calculate that return by doing the holding period return equation. That's just like the one we did on stocks. Right? You add up any income you got from coupon payments, and then you add to that the change in the price of the bond, all divided by the initial price of the bond. That gives you your return. And we looked at the yield curve. And the yield curve basically was a graphical representation, a graph that showed you the interest rate on government bonds and treasuries over different maturity lengths. So it started off like 3 months, 6 months, a year, 2 years, 5 years, 10 years, 30 years. And you could see on the chart what the interest rate for each of those time periods was. So it's kind of a way to graphically show people what the interest rate is for different time horizons, what the risk-free rate, if you will, is for different time horizons for government bonds. And then we talked about riskiness in bond investing. And riskiness is besides interest rate risk, is related to default risk, the risk of someone not paying their bond payments. And we also call that credit risk. It's similar to in consumer finance, where we all have credit scores, right? And just like us, we all get graded based on, what certain companies think our ability and probability of making payments will be in the future. It's done just like that. They look at companies' financial statements. They try to judge their ability to make payments, and they also look at their history of making payments, and they get a credit score. But with companies, instead of being like a number from some credit agency, it's a letter rating from either like S&P or Moody's or Dodge and Phelps or Phipps, and they have a bunch of these companies, and they give credit scores or credit ratings, we call them in the corporate world, to different types of bonds. And as we saw, the lower the credit rating, the higher the yield to maturity. Because a lower credit rating means the bond is riskier. There's a higher probability of default. And so to compensate for that extra risk, you'll see a higher yield to maturity on the bond. And when those bonds are sold for the first time, they'll probably also have higher coupon rates, which help compensate investors for that extra perceived default risk. Default premium is basically the extra yield to maturity above the government debt that compensates investors for the extra default risk. So you could look at the default premium on a 10-year bond. You look at the government treasury bond at 10 years, the yield to maturity, and then the yield to maturity on a corporate bond. And the difference between those yield to maturities is the default premium. Then we talked about credit ratings for companies, and they kind of, remember when we looked at them, they're like AAA was the best, and then you had AA rating, and then single A rating, and then triple B rating, and then double B rating, B rating, and it keeps going down. And we separated all those ratings into two big categories. One was investment grade, and one was junk bonds. Another name for junk bonds is high yield bonds. It sounds much nicer, high yield bonds. Investment grade, there are actually some companies like insurance companies where they're legally bound to only invest in investment grade bonds because they're considered safer. High yield bonds, just like the name implies, they have higher yield to maturities. So if you want to invest in bonds, but you want a higher return on your investment, people start looking at junk bonds. We also looked at zero coupon bonds, and they are what the name implies. They pay zero coupon. So that means you buy them initially at a discount, less than $1,000. say like 800, 900, and then at the very end, at maturity, you collect the full $1,000 back. So all your interest payments are kind of like delayed until the very end, basically. We also talked about convertible bonds. Convertible bonds basically giving the option to the bond holder to convert their bonds into a certain number of shares of common stock. These are popular with riskier investments, and the reason is because as a bondholder, you have better protection in an event of like bankruptcy. Because if a company goes bankrupt, it's the bondholders who kind of are there at the dinner table, if you will, carving up what's left of the company. Common shareholders usually get nothing when you go into bankruptcy. And so if you want to invest in a risky company, say even like a startup, buying convertible bonds is good, because if there is a bankruptcy and there's money left over, it's the bondholders who get that. But if things go well for the company, a convertible bondholder can convert their bonds into shares of stock to take part in, all the good upside of a successful company. So it kind of covers both ends, and that's why they're good in riskier investments. Chapter 7, we started talking about stocks. So it's kind of like chapter 6 with bonds. Chapter 7, we talked about concept and terminology around stocks, and also then we looked at how to calculate the value of stocks. So we looked at common stocks, and we saw how common stocks were sold for the first time in the primary market when a company did their initial public offering. But then when a company, after they do their IPO, initial public offering, now they are what we call a public company. So they go from private to being public, and then their shares of stock sell in the secondary markets, like on the stock exchanges. An initial public offering, usually it doesn't trade on the stock exchange until someone tries to resell the share that they bought in the IPO. And if a company wants to sell more shares of stock than what they sold in the IPO, they do what's called a seasoned equity offering. And reason being, right, because once a company does an IPO, their shares of stock just transact between, other investors. The company doesn't have to do anything with those shares of stock. If they want more equity capital, then they have to do a seasoned equity offering and sell more shares out of their treasury to investors to get more capital to come into the company. We looked at the PE ratio. That's probably the most popular measure of company value. Is a company stock expensive or is it cheap? People mostly look at the PE ratio to determine that. And that's just the price per share divided by earnings per share. PE ratios on the whole are pretty high right now, I think. I think it's 20, 22, 24 is the average, I'm guessing. Now, one thing is that when a company is growing fast, you'll see that they'll have much higher PE ratios. So a company like Amazon right now, I'm thinking their PE ratio is something around 150. Maybe that was Zoom, I think, was up around 200 or a couple hundred. Maybe Amazon was 100. I forget. I'll have to look that up again. Book value is basically from the balance sheet, assets minus liabilities, right? Liquidation value is how much you get for a company when you pay off all the debts and sell off all the assets. So you're kind of liquidating the company. These are different ways to look at the value of a company. The market value balance sheet is basically where we restate the value of the equity and the loans on the company's balance sheet. And then we looked at some different models on how to estimate the value of a stock. The dividend discount model was the main one we did, and that's where we forecast out dividends for every year maybe 3, 4, 5 years, I think we did, and you take the present value of all those dividends. But also at the very end, right, you had to assume a certain share price, and or if you didn't assume a share price, then you use something like a terminal value using the Gordon growth model where you assume the growth rate. And that also gave us an estimated value at the very end. So we had dividends for a certain number of years, and then a terminal value, which represented the value of the company after so many years. We took the present value of all that, and that gave us an estimated value of the stock. We had a zero growth dividend discount model, and zero growth. It's kind of related to the Gordon growth model. Gordon growth model was a dividend over R minus G. You just make G zero, and now you have a zero growth dividend model. So it's basically another way to estimate the terminal value. Constant growth dividend discount model, that was the Gordon growth model. Remember, Gordon growth model comes from Gordon Gekko from the Wall Street movie. No, that was just a bad joke. But it's basically the dividend over R minus G. And that is basically a shortcut present value formula where you have a certain dividend growing at a constant growth rate every year. What's the present value of all those dividends out into infinity? You use the Gordon growth model to represent that present value. And then we looked at different ways to estimate growth rate G, because in that Gordon growth model, we have G, right? So where do we get that G? One way was to take the plowback ratio for a company and multiply it by the return on equity. That gives us a way to estimate G. Now, what is plowback ratio? Well, we talked about the payout ratio and the plowback ratio. And the key was that those two always add up to 1, because what that represents is what a company does with their net income. Does a company pay it out as dividends? The percent of net income that get paid out as dividends, that's the payout ratio. And what's left is what a company puts back into their business. That's the plowback ratio. And that plowback of profits is what allows a company to reinvest in their business and grow the business. And that's why we use the plowback ratio to estimate growth rate. And the growth rate formula, that was G equal to the plowback ratio times return on equity. So that was chapter 7 with stocks. And then we moved on to chapters 8 through 10. And these chapters basically looked at analyzing investment projects from a business. So I'm guessing if you work for a company at some point, you're going to be involved in some projects. And those projects, somebody did the financial analysis on them to decide whether or not we should invest in those projects. And so this was kind of the 3 chapters that kind of surrounded that whole process. We started off with what should the discount rate be? And we said it was the opportunity cost of capital, which is basically, what's it going to cost the company to borrow some money or to get capital to invest? And so that is what we used. And then what we did is we used that to calculate something called net present value. And the net present value is basically the present value of all the future cash flows from the project minus the capital investment at time 0 that the company has to do. What's left is the net present value. And as long as that number was greater than 0, we had kind of a go on the project, right? But sometimes we're comparing 2 or 3 different projects. And if we can only pick one project, then that's called mutually exclusive. And mutually exclusive means you can only pick one or the other. You can't have both. And so when you have mutually exclusive projects, you basically pick the project with the highest NPV. Now, we did look at other ways of analyzing investment projects. We looked at payback period. We looked at internal rate of return. But we said those were not as good a measure of project profitability as net present value. That being said, Payback period, you basically count the number of years it takes you to earn back your upfront initial investment. If it takes you 2 years, then 2 years is your payback period. But it's up to the management of the company to decide, is 2 years good enough, or is 3 years okay, or is 4 years okay? We don't have an economically derived way to say what the acceptable payback period is. That's the issue with payback period. And then internal rate of return. That kind of uses some of the cash flows and the capital investment that we did in NPV. But what it does is, we did the calculation for this in Excel, right? It basically finds the discount rate at which the NPV is equal to zero. That's what IRR does. And so to determine whether or not a project is good using IRR, you have to compare the IRR to your cost of capital or your discount rate. As long as the IRR is higher than your discount rate or opportunity cost of capital, it's a go. But again, NPV is the preferred method because it takes into account, the amount of profits, not just the profitability or the return on investment like IRR. It takes into account also how much money you're going to be making. So that's why NPV is considered better. We looked at measuring and using free cash flows in our NPV calculations. Free cash flows are a little different than cash flow from operations, and so we went over that. And so we didn't use cash flow from operations. It's close, but there are some differences. Then we looked at how to calculate working capital because in our free cash flow equation, we actually use the change in working capital and not just working capital. Then we looked at some rules about what cash flows to include in our calculations. We call those incremental cash flows. And we looked at things like sunk costs. Sunk costs are not something that are incremental. It's money that was already spent, so they should not be included in your cash flows for a project. Capital budgeting. I always wondered what capital budgeting was. I didn't figure it out until I was getting my MBA. Capital budgeting it's kind of like, well, when you have home budgeting, right? You have a certain budget in your house or yourself, and you say how much money you want to spend in different places. Capital budgeting is from a corporation standpoint. They have so much capital to invest. How should they spend it? That's capital budgeting. Fixed costs and variable costs we discussed in that it goes into break-even analysis for a company. So let me talk about Chapter 10 then. So Chapter 10, we looked at how to take into account risk in a project. And when we do NPV analysis, we get one number and we say it's go or no go based on that one number, right? But if you're doing a really good job, you think about all the things that could happen and could go wrong and make that project kind of a loser, if you will, right? So Chapter 10 went into some of the techniques to be able to do that. And by far the most common one that I've seen and used is sensitivity analysis. And in sensitivity analysis, you take one of your assumptions in your NPV calc and you change it, kind of like expected case, worst case, optimistic case, pessimistic case. What happens when you change that one number? What happens to the NPV? And you do that for all kinds of assumptions, and you find out which numbers, when they change, makes their NPV negative. That's where your risk is. And so then you kind of dig a little bit deeper and you figure out, what can we do to change that risk? Can we do something now to mitigate that risk? And that's where the real, work comes into play to help making sure that your project's successful. Scenario analysis and break-even analysis aren't quite as popular. at least from what I've seen. Scenario analysis is where you think of some situation like what happens if there's an earthquake? What happens to our business? What happens if a competitor opens up a store right next to us? So lots of assumptions will change, and you want to see what could happen to see if there's anything you should plan for to change it. Because if you still have a positive NPV and it looks good, then maybe you don't have to worry and plan for it. But if all of a sudden your NPV goes negative, then maybe you should have a contingency plan for the project. All right, chapter 11. So this is the last one. This is the one we just recently did, and it's basically where we looked at trying to come up with how we measure returns and risk for stocks. We use the holding period returns equation for stocks, and that gives us our basic return every period. And then we talked about how do we measure the return of the market itself, the whole market. And that came down to using a market index like the S&P 500. And then we defined a couple things like market risk premium and risk premium for any particular stock. That is basically based on the extra return above the risk-free rate. That's what the risk premium is. So if you know what the risk-free rate is, which is that Treasury bill rate that we talked about, that's the risk-free rate, Treasury bill rate. It's government debt with a maturity less than a year. What's the extra return above the risk-free rate? That's called the risk premium. If we're looking at the extra return of the market above the risk-free rate, that's the market risk premium. And then we could calculate expected return of the market. And what we did is we took the current Treasury bill rate as given and added to it the historical average market risk premium to come up with what we think is the expected market return this year. It ended up we used that in the CAPM model, right? And then we looked at how to calculate risk, and we calculated variance and we calculated standard deviation. Those are two main measures of risk in finance. And then we saw how diversification, where we increased the number of stocks in our portfolio up to above like 10, maybe 20, how when we diversify, we see the standard deviation goes down on a portfolio. The standard deviation of future returns goes down. That means the risk goes down. And what we then did is we looked at that risk and broke it up into two parts, unique risk and market risk. And when the risk went down, when we diversified a portfolio, what was really reducing was the unique risk. And the unique risk is the risk of any particular thing happening to one company. If we own lots of companies in our portfolio, if something bad happens to one company, it doesn't hurt us very much. That's unique risk. It goes away with diversification. But there's part of the risk, when that curve went down, then it flattened out the standard deviation. It doesn't go away as we keep adding more and more stocks, and that's market risk. So no matter how many stocks you own, you still have market risk. And then we looked at portfolio rate of return, and that was using the weighted average equation. So the percent of your portfolio invested in stock one times the return of stock one plus the percent of your portfolio invested in stock two times the return of stock two. So that was basically a weighted average equation. That's how we calculate the portfolio. So we do a lot in finance. So that was chapter 11. And in chapter 12, we already reviewed. Chapter 13 is not on the quiz. So that is everything I have for you all. And I'm sad to see you go, but I'm glad you guys are almost done, right? So a lot of you won't have to study finance anymore. I'm sure you're happy about that. But so get ready for the quiz next week, and that is all I have for this class, for this semester. Send me an email if you have any questions. I wish you guys good luck, and study hard for your finals. You're almost done. Take
Thank you.
care. Have a great year, everybody. Bye bye.